I used to be in the construction lending business in Las Vegas. I'm now in the try to get the money back business in Las Vegas. Thankfully, Mark was kind enough to pass these out. These are the the money supply figures, and it kind of dovetails into a couple things I wanted to talk about that just kind of taking theory down to Main Street and see what happens. But if you can look at 1986 is the year that you start to see the Austrian money supply and MZM start to depart, and that's the year I moved to Vegas, and Murray Rothbard moved to Vegas, Hans Hoppe moved to Vegas, and eventually we would all come together. But that's the year I got in the banking business. And back then in the banking business, if you were a loan officer, you made a salary, and not a very good one, but certainly made a decent living. And at the end of the year, you hoped for a bonus, but they typically weren't paid. Real estate lending was looked upon with some skepticism. The real good, smart guys in the bank were the business lenders, the cash flow lenders. They were the real stars of the bank, and that was about 1986. Now, in 1995, if you could draw a circle around 1995, you can begin to see that both the Austrian money supply and MZM has kind of it's risen, of course, and beginning to back off. But it was at that point that big end of the year bonuses started to appear if you were a loan officer, especially in the real estate area. So if you began to hit your numbers, more and more banks, especially in Las Vegas, were dependent on real estate lending. That's where you were really getting your totals, because what else are you going to lend on in Vegas? You can lend on to casinos, but they're way too big. Small banks didn't have enough money to really participate. Casinos were getting their money from Wall Street by this time. So small banks really had to depend on lending to real estate projects, housing tracts, strip centers, small office buildings. And that's the way we began to get paid back in about 95. It was soon after that, about 1999 to 2001, when real estate loan officers began to get paid on commission. And this was a wonderful thing for me. And as I told a banking group recently, I've made a very handsome living making very dodgy loans for a number of years. And if I can just figure it out how to get paid a commission by collecting these loans now, I'll continue to make a handsome living. But it hasn't worked out that way so far. But bankers, because they were so hungry for real estate loans, that's where all the growth was coming from. Lending officers would get 10% of the loan fee. So let's say if you did a $1 million loan and you could get a 1% fee, that'd be $10,000. In addition to your nice cushy salary, you'd get $1,000. And in fact, you'd get paid that the very next month. You would also begin to get stock options. Were very prevalent about this time. So as things ramp up, you can see the money supply begins to increase, and that's really what's happening on the ground level. Real estate loan officers are beginning to make very handsome living. And then, of course, the next thing that happens is that all loan officers become real estate loan officers. It didn't matter whether your title was commercial loan officer or small business administration loan officer or consumer loan officer. Everybody became a loan officer because it was easy. You just lent the money and you had collateral, and the value of property always goes up, and you get paid back, and you get all these good commissions. So in fairness, senior managements of banks, they didn't feel like they could keep commercial lenders stuck just making commercial loans, which is very boring on, accounts receivable and normal banking types of functions. They let everybody do construction loans and real estate loans. So that's the next thing that happened. Also, about that time, it became so competitive making real estate loans on actual projects, whether they be housing, the vertical construction of, let's say, houses or shopping centers or office buildings. The real action was just lending on land. I mean, that was where the action was. And of course, when I came into the business, it wasn't all that long ago. It was 1986 is when I started at this, but you wouldn't make loans on land because the problem with land is it doesn't generate income. It doesn't generate cash flow. So how are you going to service the debt? Well, of course, we all came around to the notion of, well, land always goes up in value, so you make it and they'll somehow make the payments and then they'll sell it and make a bunch of money. And so you could charge more for land loans, and everybody got into the land loan business. Well, that kind of takes us to where we are today. Unfortunately, the bubble has burst despite the efforts of the efforts of Greenspan are one thing, but now you've got Bernanke who has the unfortunate task of trying to keep this scheme going. And just to let you know, values in Las Vegas, single-family homes are down 17%, 20%. Lots, of course, are land, but the entitlements have been secured, and they've made them flat and legal parcels for houses to be built on. Value of those are down 25%, and the value of raw land based on recent appraisals is down 35 to 40%. So all those nice, big, fat, juicy 50% land loans that you could never get hurt. And of course, it was always the saying, you can't get hurt in the dirt. And unfortunately now those 50% land loans are 90% land loans, and there is every possibility of getting hurt. I wanted to mention a couple of interesting stories about Las Vegas because it is kind of viewed as the epicenter of bubble making, and as a participant in that bubble making, I hear these stories, and I'm not going to tell you about anything I did directly, but I could walk you through this, but I don't see any. Unfortunately, these things are taped, and I never know who are going to see them. I'm actually, I do work for a publicly traded company now, and amazingly enough, they asked me to go on the road show to pitch the stock, and I will occasionally run into an analyst who's read something that I've written, and they try to connect the dots, and it's a very interesting conversation, and the president of the bank isn't all too thrilled about my writing at times. But anyway, I listened to a presentation the other night in California, and there's kind of this urban legend about a guy in Las Vegas who bought 200 single-family homes during the boom, and they were all supposedly his primary residence. Unfortunately, I don't think he ever lived there, and of course he's got all 200 in foreclosure at the moment. Now I don't know if that's true, but I do know of here's a more typical situation that I've heard about from a local attorney. There was a local a guy who was calling around for bankruptcy attorneys, and this particular attorney shared this story with me because he doesn't normally take this kind of work, but he was very intrigued by what the guy had to say. And this was a retired policeman from Chicago who moved to Vegas at the ripe old age of, 55. Obviously, probably retired at 100% of his higher salary and had his health care paid for life and all those kind of good things when you're a retired policeman. But he moved to Las Vegas, and he's still only 55 years old, so he got bored. And this, of course, was the housing boom, so he went ahead and got into the real estate business and bought 25 houses. And, of course, the idea was he'd buy the house and, later he'd flip them and make a bunch of money and just keep on keeping on, and that would occupy his time in his golden years. Well, he bought all 25. He used the same mortgage lender. He put no money down on any of the purchases. He bought them all at teaser rates, all with negative amortizations. But he was able to get the units rented at very cheap rates that would only cover the teaser rates. Unfortunately, last fall, the teaser rates began to adjust to say 3 times what the initial teaser rate had been, and the rent didn't cover it. And, of course, he was shopping for a bankruptcy attorney. And so I think we've got a lot of those type of, you've probably read where Vegas is the foreclosure capital of the world, and there's probably this idea that, there's moving vans leaving Las Vegas because the economy is terrible with all these foreclosures, and that's really not the case. There's just a number of investors who probably don't even, in some cases, live in Las Vegas, but they were able to buy 20, 25, 30 homes. I'm a little skeptical of the 200-home guy, but a number of people who've bought dozens of homes, put no money down, and of course they're walking away at this point. Of course, the Austrians, Murray would refer to this as the cluster of errors that happen during these bubbles. And another point I wanted to make was this cluster of errors includes people who get in the real estate development business that when the bust comes, we find out as lenders they are shockingly poor business people. They have no idea what to do. And they probably shouldn't have been entrepreneurs in the first place. But it's viewed as easy money to get into this type of business. They get in, they see values go up, they may even make quite a bit of money for a time, and there is something about wealth and IQ as they go up. Smart people or wealthy people believe they're very smart. And most people buy into that notion as well. And unfortunately, a lot of wealthy people are they're just lucky. They were in the right place at the right time. And but those two things too go together. And I guess it reminds me of that Warren Buffett quote about when the tide goes out, you find out who's been swimming naked. And and shall we say in Vegas, there's a lot of naked people out there right now. Beyond the obvious naked people that you read about all the time. But I had one particular borrower, a young couple that got into the housing construction business in 2003. This couldn't have been any better, and they had pro forma'd that they were going to build houses and sell them for $150,000. By the time they screwed around and got the houses built, they could sell them for $250,000. And these people thought, man, this is great. Anybody that would show up to buy a home, who had a pulse, who could fog a mirror, could get a mortgage. And this was great. And of course, unfortunately, about last year, that wasn't the case. Values were going down. Nobody could get a mortgage. And I remember meeting with this couple, and they said, Doug, when is everything going to get back to normal? So bubbles create this idea, and what the Fed is trying to perpetuate is a bubble economy as normal. But what we're going through now is this cleansing that Austrians know that we have to go through if it's allowed to happen. This is when the mistakes are cleared and the economy essentially heals itself. But that's not the way the average person views that. So another thing I want to talk about that isn't mentioned often is that in Las Vegas and many other active markets, there is a very active private money lending market. In other words, banks do not provide all the money that developers need. In fact, developers don't want to put any money in deal. That's a cardinal rule. As equity is a very bad thing. Don't ask me to put any of my own money in this. Of course, developers have wives and girlfriends and boats and planes and things to service. So they can't really put any of their own money into to their own projects. So they borrow private money. And a lot of individuals around town, I mean, retired people on up to just all strata of Las Vegas really participate in these. We call them hard money loans. I hate to use that term here because hard money obviously means something different to us Austrian types. But these private money lenders would pool together investors to lend to developments, and because they're actually saving their money and they are foregoing consumption, they charge more than banks do. Whereas a bank might be charging 7 or 8%, these people would insist on 11%, 12%, on up to 18%. But it began to be viewed during the boom of the construction that and the real estate market in Vegas that these were as good as a bank account. These people would make 11% coupon, they'd make a 12% coupon, but they didn't view this as a risky loan. It was just, oh, my darn bank won't, they'll just pay me 5. I've got to go over here and, I've got to go over here and make 12 to make my ends meet. But that's what happens, of course, when the Fed reduces the interest rate down below really what we know the cost of living is going up. So another aspect of credit cycles and booms is that savers are left behind. They are forced to take on more risk than they should ever take, and they don't think they're taking risk. Well, just recently, a very significant landholder beyond the federal government owns 87% of the land in Clark County, Nevada, owns 87% of the land in all of Nevada, and that's another issue. But be that as it may, one of the private landholders had borrowed $500 million from private money sources. They issued a press release in January that they would no longer be able to make payments on this $500 million. And so there are people all over town, all over Vegas, and many that I am sure are counting on that 11% check every month to live on. And I just, this week, they issued another press release that they are going to ask those lenders to forbear for 3 years without interest, and then may ask for a 3-year extension beyond that. Now, some of these lenders, frankly, won't be alive in 6 years, and so I'll go back to my land valuation that I had earlier. The value of their collateral has been cut in half, and the borrower is stopping payments. So these folks are really in a bad way. And so the credit cycle and the pain of the bust is going to affect really a lot of people in Vegas beyond the development community and beyond the banking community. But how much time do I have? As long as I could go. I could be here all day. Good grief. All right. I did want to make a point about stock value of banks, because I was in, when I got the email from Joe to participate in this panel, which is now not a panel, speaking engagement. But anyway, we were meeting with investors right now, especially bank investors, especially people who own your stock and their holdings have actually been cut in half. It's not terribly pleasant talking to people, but in some cases when you meet with analysts, it's very instructive in terms of the valuations that they're making for stocks. And for people who are interested in markets, who want a great project, there is a very active market for small banks, big banks, very regionally oriented banks. And as we've watched the Austrian business cycle unfold in real time, stock values are reflecting for banks that a lot of them are going to go out of business. And a lot of them will, if they don't go out of business, they're going to have incredible charge-offs. And in fact, there was an analyst that met with our bank, and he actually values our stock twice what it's trading for. And we said, well, gee, you don't want to buy it today, do you? No, but I asked him later, I said, how does the market, if you value us at twice what we're trading for, how does the market get to the number they get? And he had this great sort of analysis, and the bottom line, I won't bore you with the details, but he essentially believes that the market believes that in the case of our particular bank, that we're going to charge off 12.5% of our loans. Now that's an incredible amount, and I'd like to think he's not right, obviously. But and there are people shorting our stock from the level we're at now. So obviously they're betting that it's going to be even worse than that. And so anybody looking to do research and see how they come out, I think you'll be able to see how, and it's not just our banks, it's all banks, and whether it's banks in Atlanta who lend on real estate, or Florida, or Las Vegas, or California, we're all in the same boat. I use this as an example just because I met with this guy personally, but I think that it's very interesting how the markets can forecast. And I know it's been a topic of discussion before, but again, as this thing unwinds in real time, it's a very interesting topic. The thing that's being talked about a lot right now, gee, what's going to happen? What's going to turn this around? And I don't know if you, I don't make a habit of reading this publication, but I was stuck in Atlanta airport for a couple of hours. Wall Street Journal had a piece by, I'd rather be stuck in Hong Kong airport, actually, but brainstorming about bailouts. And I can tell you that they've got a Nobel Prize winner, Myron Scholes, actually, and he essentially he believes that the government should essentially buy up all the paper, and which it makes me think. Each week we learn about something else they'll collateralize or they'll take, and I think they'll begin taking the IOUs from the Friday night Fed poker game as collateral. But when you meet with investors, you meet with portfolio managers, and it's kind of a two-way dialogue. When do you think it's going to turn around? What's it going to take to make this work? The government is the answer. And whether it's the Fed, or whether it's Congress, or whether it's Bush, or whatever the case may be. Everybody has kind of a different take on it. It does not involve the market. It does not involve a collapse of the banking system or anything like that, doing away with the Fed, you know, a return to gold. None of that is being talked about. It is merely everybody is looking for Uncle Sam to bail this thing out. In fact, but I will tell you that there's a rumor the FDIC, the Federal Deposit Insurance Corporation, and they are a corporation. Don't think they're part of the government. Their field staff has reminded me many times, I work for the corporation, not for the government. But you can imagine what those 3 weeks are like when I have to deal with regulators for 3 weeks. But they have identified 40 highly concentrated real estate banks around the country, and they are actually pulling experts out of retirement within their staff to come out and do an examination of these banks and determine what's going on out there. But that is, you know, that is the good news from the front, and I think that I believe that the Wall Street Journal actually had it right in another sense. They said, "Attention, regional banks, you better be out raising capital." Because and they mentioned some fairly large banks here. One in our area, Zions Bank, but Synovus Bank Financial in Columbus, Georgia, of all places, must not be too far from here. Regions Financial in Birmingham, Alabama, they indicate better be raising some capital to keep on keeping on during this meltdown. But I was an active participant. It's very ironic. Studied directly under Murray Rothbard, did a lot of work on financial bubbles and busts, and I really didn't think I'd participate directly in real time, but one of these days it'll make a heck of a story, and maybe I can come back and tell the whole thing start to finish. But, Mark.